forefront of our mind this week has been the fact that low bond yields seem to have become more embedded in the market psyche, and the prospect of them staying lower for longer seems to have risen. So we've got a degree of complacency about where bond yields are at the moment, which is driving equity markets higher. This week, the net speculative positioning on US Treasuries reached the same point that we got to in 2012, the height of fears over the Eurozone crisis, which actually subsequently in the 3 months after that sort of boiled over, and we got a backup in yields. But just looking at the valuations that bonds have now got to, if you look at the UK Treasury yield, you're on a negative 1.15% if you're taking implied inflation rates at 2.5%. They now look very expensive on any metric. So here's the US Treasury market rebased into a PE, which is the inverse of that yield, against the investment grade corporate bond market, against the S&P. So it's not necessarily the absolute level of those PEs, which is obviously extremely high, above 70 times, but it's the relative PE and where it is to the historical range that is particularly notable. We ask whether that is justifiable by the economic data, and we go back to this economic surprise index because it's the best aggregator. Since the end of Q1, we've seen a notable increase in economic activity and positive surprises coming out of the global economy at the same time as those bond yields have continued to fall. So the global growth shock that has stimulated this rush into treasuries and bonds, which has pushed those yields down, doesn't necessarily feel justified by the data. Particularly if you look at the US economy, where we've continued to see firms and businesses create new job opportunities for the employment pool. And here you can see that survey, the JOLTS job opening survey, is pretty much near its highs. Same time you've seen the pool of unemployed gradually decline. And now we're at a point where that discrepancy will probably, if it persists, start to create some wage inflation in order to draw people back into the employment pool in order to take up those jobs. At the same time, we've seen a stabilisation of commodity prices, which again takes that deflationary impulse out of the global economy. And we could move from a point with bond yields where they are, where there's an implied deflationary assumption. We could, over the next few quarters, move to a slightly more reflationary trade, which would mean a bit of a backup in those yields. The equity market has been well supported by those falling bond yields, because obviously the equity market is a relative investment, and if value is very poor in the bond market, then people will move to those bond proxy-like equities, which has done extremely well, particularly since Brexit. As you can see here, management businesses and companies have tried to encourage investment through the use of dividend, and the payout ratio of the FTSE has gone up quite markedly since 2012 in order to encourage investment flows and provide that alternative income that people are looking for, which they're not getting in the bond market. So you can now see the payout ratio in the FTSE at 160%, so above, paying out more dividends than they're earning, and that's largely because of the big oil companies, which accounts for a large proportion of the FTSE 100 dividends. But it's cheap debt again that is enabling companies to pay out those dividends. Moving to the week ahead, it's a very, very active schedule. I won't go through all the names, but this really will characterise the next few weeks in terms of equity market performance as we digest what firms are delivering in this low growth environment, and where we're seeing those firms that are struggling. Thanks very much.